So you are telling me Sam Altman just woke up and decided he wants to be Bob Iger?
OpenAI buying TBPN is peak 2026 bingo. But Nate, they just bought a Hollywood headache while global deal volume is actually down 17%.
Who cares about volume when value is up 26%? 1.2 trillion in quarter one alone. The mega deal is back.
Only because private equity is sweating bullets trying to offload their stale assets. But fine, let us look at this OpenAI streaming play. The rundown.
Look, you can literally smell the desperation from the private equity sponsors right now.
Oh, the limited partners are furious. They want their cash back.
Exactly. You have these aging portfolio companies sitting there like stale bread. Cross-border M&A is at its highest first quarter level since 2002, entirely because sponsors are begging anyone overseas to buy their bags.
Which completely explains the macro data we just got. Global M&A activity surged past $1.2 trillion in the first quarter. That is a 26% jump in deal value.
But volume is down 17%.
Right. People are buying fewer things, but they are writing massive checks for the things they do buy, like Zurich dropping an £8.1 billion bid for the UK insurer Beazley.
Massive specialty insurance play. I actually love this for Zurich. Clean cash offer.
You love it? Have you looked at Beazley's exposure in the cyber market? Zurich is paying an enormous premium just to inherit a massive tail risk.
Oh, come on. Scale is everything in specialty lines. You need the big balance sheet to absorb the hits.
I will believe it is a smart move when I see the board actually accept the offer. They are still sitting on it. Keep an eye on London tomorrow.
Fair enough. What else is clearing the wire? Publicis is buying the sports marketing agency 160/90 from WME.
And Molson Coors just closed on Atomic Brands, because apparently the market desperately needed more Monaco cocktails.
Hey, do not disrespect the ready-to-drink portfolio. That is high-margin party juice.
Spoken like a true former banker.
Guilty as charged. But the real shopping spree is happening in pharma. Merck, Eli Lilly, and Biogen just combined for $18.6 billion in recent acquisitions.
And they are mostly paying for pipeline dreams. I read the footnotes. They are paying massive multiples on drugs barely out of phase 2 trials.
They have to. Look at AbbVie and Amgen sitting on mountains of cash. If Lilly doesn't buy the asset, someone else will launch a counterbid tomorrow.
Sure, because fear of missing out is historically a flawless valuation model.
It works for tech. Speaking of tech, the AI megadeals are what really pushed us past that $1 trillion mark. We have to talk about the weirdest headline of the week.
You mean OpenAI deciding they want to be a Hollywood studio?
Yep. I need you to explain this TBPN streaming deal to me, because honestly, my brain is still broken from reading the press release. The big one.
$1.2 trillion in a single quarter.
And deal volume is actually down 17%. Everyone is just hunting elephants right now.
Specifically, AI-powered elephants.
Which brings us to the absolute wildest press release I have read this year. OpenAI buying TBPN. Sam Altman is officially going Hollywood.
I read the filing 3 times trying to figure out the exact strategic rationale here. An AI infrastructure giant buying a streaming platform. It feels like a massive distraction from their core business.
It is a pure distribution play, Maya. You have this god-tier generative AI engine for video, but you need eyeballs. TBPN gives them an instant subscriber base and a native platform. It is the classic build versus buy scenario, and OpenAI just hit the buy button.
See, I completely disagree. I do not think they care about the current subscribers at all.
Oh, come on. You do not drop billions on a consumer streamer just to ignore the users.
You do if you are starving for legally cleared training data. Look at the copyright lawsuits piling up against them. Buying TBPN gives them an entire proprietary vault of licensed movies, television scripts, and high-quality audio to train their next-generation models on. The subscribers are just a bonus. They bought a legally compliant data farm disguised as an entertainment company.
Okay, that is actually a terrifyingly smart take. You think they are just going to strip mine the IP?
I think they are going to feed it directly to the machine. And the fact that they spun it as a strategic expansion into entertainment is just beautiful corporate theater.
Spoken like a true cynic. But look at the broader market. This is exactly why overall deal value is up 26% while the actual number of deals is dropping. Strategic buyers are prioritizing massive scale building AI infrastructure acquisitions. They are skipping the cute little tuck ins and going straight for the jugular.
Meanwhile, the private equity shops are just sweating in the corner watching tech companies have all the fun.
Oh, the limited partners are furious right now.
They really are. The pressure on financial sponsors to finally monetize these aging portfolio companies is reaching a boiling point. We are seeing cross-border M&A hit its highest first-quarter level since 2002. Sponsors are literally flying across oceans, desperately trying to offload stale assets.
I talked to a former colleague yesterday who sounded like he was trying to sell me a used minivan, but it was actually a mid-market logistics software company. Just totally frantic. They need these assets off the books to show some returns.
Which perfectly explains why Zurich Insurance is suddenly launching an £8.1 billion takeover bid for Beazley over in the UK. Everyone is looking everywhere for a match.
We are definitely keeping an eye on the UK public market tomorrow to see if Beazley's board formally responds to that cash offer. But you know who else is throwing around huge piles of cash right now?
The pharma giants.
Exactly, because Merck, Eli Lilly, and Biogen just spent $18.6 billion, and I need to know who Amgen and AbbVie are going to buy next to keep up. Voices. I'm looking at this analyst note from this morning claiming buyers are, quote, prioritizing scale-building AI infrastructure over smaller tuck-ins.
Right, because deal volume is actually down 17%, but value is up 26%, crossing 1.2 trillion.
Exactly. The narrative they're pushing is that everyone suddenly woke up and decided to only hunt whales.
Which is entirely a math illusion. You have OpenAI buying a streaming service and a couple of other massive AI swings skewing the entire quarter. It's not a broad strategic shift. It's literally three guys in Silicon Valley distorting the global average.
Oh, come on. That's too cynical even for you. The intent is real. You don't accidentally spend $50 billion on infrastructure. Strategic buyers are looking at their organic growth, panicking, and deciding they need to buy the whole neighborhood instead of just the house next door.
I'm just saying, don't confuse a few concentrated megadeals with a healthy M&A market. If you look at the footnotes, the middle market is still completely frozen.
Well, the middle market might unfreeze soon out of pure desperation. Did you see the commentary on financial sponsors?
The mounting pressure from LPs to monetize.
Mounting pressure is the polite way to phrase it. LPs are grabbing pitchforks, they want their cash back.
And the sponsors are stuck holding these aging portfolio companies they bought at peak 2021 multiples.
It's basically a frantic rush to the exit doors. They're actually looking overseas now. Cross-border Q1 volume is the highest it's been since 2002. We're talking aggressive international matchmaking to offload stale assets.
Selling your tired 5-year-old SaaS company to a European conglomerate because the domestic IPO window is nailed shut.
Hey, whatever clears the books and gets the limited partners off your back. But speaking of massive cash deployment, we need to talk about what's happening in the pharma space.
18.6 billion reasons to talk about it, actually. Spill the tea.
So the whispers I'm hearing from the LP side are getting loud, like deafening.
You mean the private equity sponsors sweating bullets over their aging portfolios?
Exactly. These assets have been sitting in the window display for 5, sometimes 6 years. The limited partners are finally slamming their fists on the table, demanding liquidity. It's a frantic rush to the exit doors right now.
I was looking at the cross-border data this morning. Q1 is hitting the highest level since 2002. You know exactly what that means.
That global synergies are finally back in vogue?
Oh, come on. You know that's pure banker spin. Stop it. It tells me they're completely desperate. They can't offload this stale inventory domestically, so they're dumping it overseas. It's aggressive international matchmaking.
Hey, don't knock the international strategy. Sometimes you have to cross an ocean to find someone who doesn't know your baggage.
That's incredibly cynical, even for you.
I call it being a realist. Look at the industry chatter right now. Everyone is bracing for a massive wave of secondary buyouts, sponsors selling to other sponsors just to manufacture some liquidity.
Which is literally just passing the trash. I read the footnotes on a couple of these recent pitch decks. They're stripping out all the long-term R&D costs just to make the EBITDA look pretty for an overseas buyer. It's corporate catfishing.
Okay, sure, the makeup is applied a little thick. I'll admit I sound like a banker right now defending a bad pitch. But if a European buyer desperately wants a North American footprint, they'll pay the premium. The strategy works.
It works until the deal closes and the buyer realizes they bought a hollowed-out shell.
Fair point. But speaking of European buyers throwing serious cash across borders, are we going to talk about Zurich launching that £8.1 billion takeover bid for Beazley?
We absolutely have to. The UK public M&A market is waiting to see if the board actually takes that cash offer seriously. Tomorrow's radar.
Tomorrow morning, the PE secondary market is going to be a bloodbath of pitch decks.
Bloodbath is a strong word for sponsors just finally doing their jobs.
They are desperate to liquidate aging portfolios. Cross-border M&A is at its highest first quarter level since 2002. They are frantically looking overseas to offload stale assets.
Stale assets, spoken like a true recovering banker. But I don't buy the desperation narrative. Look at the UK. Zurich just dropped an £8.1 billion cash offer for Beazley.
Exactly my point. Look at that cash.
Right, but Beazley's board hasn't even blinked. If targets were truly panicked, they would take the first exit ramp. We will see if they actually respond tomorrow.
Fair, but keep your eyes on Pharma counterbids tomorrow. Merck and Lilly just spent $18.6 billion. Amgen and AbbVie are sitting on cash having major FOMO right now.
FOMO is not an investment strategy, Nate.
It absolutely is. Have you met pharmaceutical executives?
Point taken. I will be refreshing the SEC filings at dawn to see who panic buys a biotech startup.